Good day all, and welcome to this session. We are happy to have with us Cyrus Driver, Managing Partner at Partners Group in Singapore and Managing Director of the group's Private Equity Technology Business Unit. Now, Partners Group is a global alternative assets manager headquartered in Switzerland with some $120 billion in assets under management as at the end of June 2021. About half is invested in private equity with about $60 billion in assets under management. Now, this morning's topic is applying global lessons to Asian tech investments. Now, the last time we spoke, Cyrus, you mentioned that Partners Group is expecting to allocate 15 to 20% of global tech investments to opportunities in Asia as a starting point. Maybe we could start off. Do you consider this path a significant change from what Partners Group counted as a core investment thesis, say about 5 years ago?
Firstly, Michelle, thank you for having me. Before I answer the question, I'd just like to set the context on a couple of points. For one, we have historically invested about 15% of our global investments in Asia, 15 to 20% broadly speaking. And this has been true over time and across sectors, and it has also been true of our technology investing team. The second context I just give is that we never have a firm allocation to any geography. We search for the best relative value across the world, and the focus is more on which transformative theme are we backing and less on which part of the world. So while we would expect to invest over time 15 to 20% of our tech investing in Asia, could be a bit lower, could be a bit higher, just to set that context. And then coming to your question, is this a departure from the past? I think in some ways it is, and in some ways it's not. It's a departure to the extent that we have historically been a later stage investor. The large bulk of our track record has been in buyout investments, where either we alone or we and a partner have a majority stake in a business and are able to therefore more directly impact the business's transformation. The departure here is that we recognize the amount of fundamental change being driven in technology by much younger businesses. And it has always been our DNA to seek out that transformative change and ride that growth. So we've always been a growth-focused investor, albeit in the buyout world. Rarely has our investment thesis been driven by, say, cost synergies or cost cutting. It's always been driven by growth. So we're staying true to that DNA, but we are expanding our tool set to go from purely looking at buyout opportunities with growth potential to looking at much younger businesses. And in fact, with typically much more transformative or higher growth opportunities. In the technology vertical that I'm part of, and we're organized into 4 verticals globally, in the technology vertical in particular, some of the most exciting businesses are younger stage. And so I can tell you that as an investment team, we're really excited with this greater flexibility that has come about in the past couple of years. And we've already made some very exciting investments. We expect to do a lot more going forward.
Right.
Does that answer the question, Michelle?
Yes, thanks. Just to follow up, as you're saying that as a PE firm, you have traditionally done sort of buyouts and control investments. But I guess most of the sort of hot tech opportunities do not quite offer this. I mean, what is the mindset change here for you?
Yeah. So I think the mindset change is, it is a change, and it's also not a change, is that we focus on where growth is available and where there's a transformative change happening. And I'd emphasize that transformative investing part, it really does define what we do compared to a lot of our peers. And the underlying point is that if you're just backing an existing growth trend, then you're effectively getting returns of the beta of the market. And then you expose yourself to the current pricing level valuations in a big way. Whereas if you're able to do your own research and spot where there's going to be transformative growth, that's when you really get alpha and higher returns. And this has been true in the past as well. Going forward too, we intend to do the same. We're just agnostic to whether that opportunity is coming in a business that's a bit younger or one that's quite mature. And both are giving us strong returns. So early this year, we invested just under $1 billion of equity to invest in a buyout situation in the US in a company called Itera, which is a very exciting business with a range of its own developer tools. These are software tools for developers of all kinds, and is going through its own transformative growth, no less exciting than younger businesses like VFox in Europe, which is a digital insurance provider, where we made a relatively much smaller investment in a much younger business, but it itself is transforming how insurance is distributed and marketed in Western Europe. So there's opportunities at different life cycles of firms. I think the key link needs to be a transformation that we have conviction in and we're backing the team to execute towards.
Right. But even so, I mean, is there sort of a different way in which you assess the business model, for example?
Yes.
I mean, how different
Yes.
is it?
Yes.
What adjustments
So,
are needed?
Adjustments are definitely needed, Michelle. And maybe if I could just, there's a continuum of how early stage of business might be and what the risk reward is. And for simplicity, let me break investment opportunities into three buckets. The first is one where you're investing behind a concept or an unproven business model or product. There are very smart people in very successful venture capital firms that do that. That is not our DNA. So that is not something we seek to do. At the other end of the spectrum are well-proven businesses, very cash flow generative, profitable leaders in their space, but now relatively more mature and proven. That's where our typical buyout model works well, and we look for transformative trends within such businesses. In the middle, which is where we're expanding to, are businesses that are still in a rapid growth phase and are therefore most likely loss-making, most likely cash burning. However, their core product has established product market fit. And again, we're more focused on enterprise technology businesses than consumer technology. So, SaaS businesses, vertical marketplaces. In those businesses, when we invest, even if they're cash burning, even if it's a growth round, product market fit will have been established. So we don't see it as our role to bet on product market fit. We see it as our role to help the business do better in its go-to-market, often leveraging experts we have in the portfolio around the world. We see it as our role to help businesses expand faster if M&A can be strategically accretive to them. So we will likely be of value to those entrepreneurs that want to drive not just organic growth, but also consolidate their industry or widen their product offering or enter new markets through M&A. And that piece of working with younger businesses still cash burning is admittedly new to us. The other elements of transformative growth, helping with go-to-market, helping with M&A, are not.
Right. So it sounds like these are some of the lessons that you can bring from your experience with non-tech investments, the option for M&A and all.
Yes. Well, actually, lessons from tech investments, which we do a lot of, but they tend to be more mature.
Right. The other thing is, deal making in tech also seems to be done sort of very quickly in a matter of days or weeks. How does this gel with a firm like Partners Group? You are sort of large and process driven, and the opportunity to do deep due diligence.
Yes. I will say we do spend a lot of time building internal consensus on a key theme. So, for example, we spent all of this year already building our conviction around the growth of SaaS in Asia and different themes for different parts of Asia. So in China, for example, it's very much a play on domestic corporate digitalization, whereas in India, Southeast Asia, and Australia, it's a play on SaaS firms from here being able to penetrate first the US and then global markets. So we do spend a lot of time building that thematic consensus, deciding what businesses are high priority for us and getting familiar with them well in advance of when they're either raising capital or there's going to be a change of control. So we do a lot of our work in advance, Michelle. And therefore, while once a transaction is fructifies, things may move quickly. We tend to focus on those opportunities where we've already spent quite a bit of time. Quite often, we will have been researching an opportunity for almost a year, sometimes over a year, before the final opportunity presents itself. So we would participate and compete only for those opportunities. Again, we're not, it's not our DNA to meet a business, no matter how exciting it is, meet it and make up our minds in 2 weeks. That would never be the PG approach.
Right, understand. So as you said, you've picked up sort of software services providers in the US and also this thematic study that you've just explained, but wanted to understand, go a little bit deeper, what are the particular opportunities or sort of investment strategies that are particular to Asia?
Yes. So I think our three top focus areas for Asia Tech are, first is SaaS. And SaaS can mean many things. So there's sub-segments within it, but let's say SaaS. We have a deep conviction that Asia's GDP dwarfs that of the West, but the use of software and the development of software tools is still lags substantially behind. And therein is the transformative opportunity that we would want to back. We also see not just a deep pool, but almost a sea of well-funded venture investments with very smart management teams that are now breaking through and have already broken through for globally relevant SaaS businesses. So we see a huge amount of opportunity over the next few years. This is not a 1 year or a 2 year strategy, but a multi-year strategy. So number one, I'd say SaaS. Number two would be technology services, where there are already across South and Southeast Asia itself, multiple globally relevant technology services businesses. We've invested in two ourselves and made good returns each time. We've invested in such businesses in the West as well. And the focus there will be that technology services keeps evolving every few years. Every global technology trend translates to derivative services trend. And so we want to pick the businesses that are ready for the next 10 years as opposed to that did well for the past 10. So that would be a second most important theme. And the third would be vertically focused marketplaces or vertically focused classifieds plays in the internet with a strong network effect. So there are a lot of opportunities in the broader consumer internet space that we are not the right guys for. We haven't done the thematic work. It requires a different mindset than ours. A lot of the consumer internet plays. We'll focus on our strengths, which typically relate to enterprise tech or to marketplaces where there is a network effect. Those businesses globally have become owned by private equity quite often, and there's a number of reasons for it. There's also a few reasons why the private equity toolkit works well for those businesses. So that as well would be one of our priority sectors, and that would round out the top three for us.
Could you maybe explain a little bit by what do you mean the private equity toolkit works particularly well for the sectors you just mentioned?
Yes. So maybe let me speak to our toolkit, and every private equity firm has a slightly different toolkit. So for a consumer internet business that is often pre-monetization or is fighting for eyeballs versus revenue, it requires a mindset that I think comes more from our friends in the venture capital world or often from successful entrepreneurs. For private equity, and definitely for Partners Group, we like to have a more specific value creation plan that can last 2-3 years, that we pre-agree with the management team, with the board, and then work hard to achieve. On the consumer internet side, our experience has been the plan has to change way too frequently and is too often impacted by external events. So it does need a much more flexible, much quicker pivoting approach, but also less certain. And therefore, that is better suited to pools of capital that can live with a high loss ratio, some very big winners and many losses. If you look at our investment approach and our portfolio, it would be very rare to find a business that has, or an investment that has lost value. And that's because there is a certain amount of visibility for the next 2, 3, 5 years and an ability to plan for it and then focus on that plan. And we see that kind of stability or visibility in a marketplace model where network benefits truly exist, not in most parts of the consumer internet. Hence the preference.
Right. I mean, these opportunities that you are talking about, would these be in the larger markets of China and India, for example? And how do you see opportunities in Southeast Asia?
It could be China, India. I think they would probably more likely be in Southeast Asia. For a counterintuitive reason. China and India are large enough markets that when you have a leader with a network effect, it will go from venture funding to IPO. And I don't think we can add value in the middle of that journey. Whereas in Southeast Asia, there are ring-fenced markets, ring-fenced not by regulation alone, but also by culture, language. And in those markets, I think we would find more assets where our capital can be value additive and where there is a role to perhaps roll up such leaders across different parts of Southeast Asia, or where the ultimate addressable market is not so large that an IPO is the natural path, but instead ownership with an active investor is the natural path. So we think we'll see more opportunity here, and we have been researching some. We have been in conversation with some already, but I shared with you, we tended to research well in advance, so there's nothing impending.
Right. Just to understand, to what extent do you see yourself competing with the VC firms then, based on what you said in terms of the opportunities in Southeast Asia? And also as businesses grow, the scale much faster and more capital is targeted. I mean, do you see yourselves competing even in the earlier growth stages?
Yes. So I don't think we'd go to answer your second question first, Michelle. I don't think we'd go to earlier growth stages. And for us, the key is the product market fit must be established. And we'd back a business that has shown early leadership in its core segment, even if it's a small segment. And that will limit us from going too early. Venture capital firms, many of them are actually partners for us because we can help provide them an exit on those investments that have done well and grown to a size that we'd be interested in. We do bring a certain global capability and skill set that could be helpful to the business. So they might be great at brainstorming with the entrepreneur, sharpening the product market fit, the business model, helping them think through the many different growth avenues where focus is required. They may have other early stage investments around the world that can add value. So there's a phase in which venture capital firms are extremely value additive. And then those assets that rise to a scale where they have global ambitions or they desire global resources, we could be relevant. So we see them largely as partners. Of course, venture capital has scaled a lot. So there are some VC firms that will invest across all stages, and then we will inevitably compete in the later stage opportunities.
Right, but do you see a gap in a particular stage? I mean, Series B plus or C, something that Partners Group can fill?
I think there is a plethora of venture capital funds to invest in Series A and B and C. At least in Southeast Asia, I think there are relatively fewer that do Series D and above, and also round sizes of say 150 to 100 million. There are players, of course, there are, but relatively fewer. So I think that is the space where we think we could be more differentiated and make a space for ourselves.
Right. So just to take a step back, to what extent has the pandemic and how it has disrupted businesses sort of informed, the decision to put more attention on tech investments?
Yeah. I think it has accelerated a few existing trends. And again, I break the impact of the pandemic into two parts, Michelle. One is its impact on consumer internet businesses, where their demand has just grown tremendously. They've had maybe 5 years of growth in the 1 year of 2020 itself, because consumers have perforce needed to transact online. We don't spend too much time on those businesses, as I shared with you. So that has not impacted our investment thesis so much. But the second impact of the pandemic has been to accelerate the digitalization of the economy more broadly. As all enterprises have been working from home, and have started seeing the benefits of technology, adoption of technology across supply chains, across the inner workings of corporates, across building their own go-to-market to their consumers. The demand for software and SaaS and technology services of all kinds has grown tremendously, and that has shaped and has impacted a greater desire to be more active in tech. So our existing portfolio in technology has done very well as a result. Also, the number of opportunities we see of businesses that are seeing transformative growth has just multiplied. So I'd say that second effect it has been really profound. And then, we have reflected on whether this is a short-term spurt in digitalization or whether it's a structural change. And in our view, it is a structural change. And we do see that then compounding and accelerating going forward.
Right. So just moving out of pure tech, we're looking at particularly the tech-enabled businesses that you've invested in. I mean, you've Partners Group has typically taken the buy and build approach, for sale or future listing. But are there opportunities here, for example, where Partners Group or a PE firm can pick up assets in the US and Europe and combine them or leverage sort of the back end and cost arbitrage in Asia?
Yes. So I think the cost arbitrage play has become less important over time, Michelle. But I think there's just such a large number of tech firms founded from Asia. And within them, there are some that are really world-class in their product or their service and their ideas. Their growth can be accelerated by acquiring businesses with a foothold in the US and Europe. So we definitely would keep doing. We've done it with our existing portfolio already. So with the SPI, a tech services business from Philippines, we did 3 acquisitions over 3 years, and it's become the leader in creating online learning content for edtech in the US. It's one of the leaders in edtech enablement for remote learning for US universities, but it did it by combining its own capabilities and strengths with strategic acquisitions in the West. And we would want to do that with many other entrepreneurs, many other businesses to accelerate the go-to-market. But I think cost arbitrage is useful incrementally, but it doesn't drive business models today. It's much more about winning the customer.
Right. So it's the other way around then, what you said, Asia companies looking to grow in the US and Europe. I see.
Yes.
So at the same time, however, we've said all this, but Partners Group isn't really the only one looking for opportunities in this area. And at the same time, there's also a growing pool of capital targeted at Asia and at tech opportunities in particular. So
Yes.
what do you make of this?
Yes. So I think if you open up a news site these days, it is humbling to see the number of smart investors, the number of smart entrepreneurs, the amount of exciting businesses getting funded and growing and doing things. So it is a much larger ecosystem than it used to be. And there are many other competitors of ours that we respect and believe do a very good job. So our approach is just to have focus, Michelle. So we spend a lot of time figuring out what are areas of focus. Within that, what are the businesses we would love to participate in and be invested in, and to chase them. And then we try to just cut out the noise and take things one investment at a time. It is a very competitive time. We also think that the level of competitive intensity from capital, there's a lot of capital in the world right now, it will moderate, it will dissipate, it cannot sustain at this level. So we're also building a pipeline for investments we can make next year and 2 years from now, and not letting the current moment shape our strategy, but rather look at the next 2 to 5 years. I may not have answered your question, Michelle, but I guess what I was trying to say is there's definitely a lot of competition, and we try to focus on where we can add the most value, and beyond that, not worry too much about what others are doing.
Right, because I was just going to ask a follow-up on, what is the effect on valuations, for example, with with all this dry powder, do you see any frothiness, and how do you mitigate that?
Yes. So it's a hard question to answer, Michelle. It's a hard question to answer. We have felt, I can say definitely for myself, I have felt that valuations are on the higher end every year for the last 3-4 years. But I think on the tech side, what has also proven true is that organic growth has been much stronger than people expected. The adoption of technology by customers has been much stronger. And the stickiness of those relationships have been much stronger. So the stickiness of a technology, either a B2B customer relationship or even B2C, has been surprised to the positive. So there is a reason for multiples to go up. Has current liquidity taken them up further than they should be? It's very hard to say, except with hindsight. But we do worry a lot about current valuation levels, Michelle. Our own approach is we look for the best quality opportunities. We look to back the right investment theses. And then we just accept that there is a certain amount of macro risk that is not in our control. And we try to focus on everything that is within our control with the business itself.
Right, because how much pressure is there really on GPs to deploy, and how much more sort of proactive or creative does one have to be in terms of deal sourcing or deal making?
Yes. So our own approach is sourcing, remains very, very important. So the wider your funnel, and the earlier you reach an opportunity, the better the chance to get in at the right valuation. But even more so than that has become, what do you do post-investment? And so we do believe the ability to transform a business and to support that transformation is also what's distinguishing people's returns. Coming back to dry powder, I will say though that there's two ways to look at dry powder. One is simply in terms of how many billions or trillions of dollars of dry powder there is. And the second is to see it in how many quarters of investment pace it represents. And what's surprising is that the dry powder at current pace has actually come down globally over the past 12 months a little bit. So if the current pace of investment continues, dry powder is actually edged down over the last couple of years. But in absolute amounts, it's still at a record high.
Right. Okay, so against this backdrop, how do you see Partners Group's allocation sort of evolving, I guess, over the mid to long term?
So we've been fairly steady with our investment strategy. We just announced yesterday the latest generation of our private equity fundraising, and we've raised $15 billion for strategies across verticals. But we are not foreseeing a change in our core investment strategy. So we continue to be largely focused on the mid-market, entirely focused on transformative investment themes, well diversified across the 4 investment verticals we invest in, Michelle. So I don't think we're going to change what we do, except that we keep growing as a team so that we can source deeper. And the one big change we made last year that I think is very well placed is that we verticalized globally. So the investment team was historically geographically organized, and now it's vertically organized. So everyone is focused on one vertical through the year. It allows us to maintain much deeper relationships with entrepreneurs, with management teams, with shareholders of different assets, and keep visiting the same people and seeing how things evolve. That's probably been the one big change we've made to our strategy. Otherwise, it's been working well, and so we continue to double down on it.
Right. So last question for me. In your view, given this, whether you call it a protracted pandemic environment or something that's endemic, what is next for private equity firms? What is the key challenge, or how are you going to mitigate it?
Yes. And this is just my personal view. I think macroeconomic volatility is going to go up. It's just my personal view. This is not necessarily a house view. Macroeconomic volatility is going to go up, and it is going to shake out a separation between higher quality investors and less so. And quality will prevail. We have been in a bull market for a while. Despite the pandemic, the market itself has been in a bullish state for a while. It cannot last forever. And when a market correction comes, it could be fairly large. It could be triggered by geopolitical events. It could be triggered by a large real estate firm collapsing. But whenever the trigger comes, I think there will be a correction, and then quality will show through. So quality businesses, truly active investors will be differentiated. At this point, with the bull market, sometimes, a rising tide lifts all boats. So our approach, therefore, is to stay close to our fundamentals and stay focused in what we do, because we do expect the world could be quite different in 6 months or 12 months or 24 months.
Right. Thank you. So on that note, thank you again, Cyrus, for joining us. This has been the session on applying global lessons to Asian tech investments with Cyrus Driver, managing partner at Partners Group in Singapore. Thank you again.
Thank you, Michelle. You just promoted me. I'm actually a managing director, but I'll happily take it. Thank you. And thank you for your time.
Thank you.